investing meetup. We have an amazing guest today. It's Ryan Severino. He's going to talk about his view on moving past 2020 into the 2021 and what the future holds for us. Ryan is a chief economist at GLL, where he manages the economics team, and he's responsible for the global and regional economic research, analysis, and forecasting, as well as property market forecasting. Ryan also currently serves as an adjunct professor of finance and economics at Columbia University and NYU, and he's teaching courses such as urban economics, portfolio and risk management, micro and macroeconomics. He also has experience in real estate, asset management, portfolio management, and acquisitions. Ryan's research and analysis has been published in many well-known publications such as Wall Street, New York Times, Financial Times. He's been featured at CNBC, Bloomberg, and he has a lot of other memberships and achievements, which I'm sure he's going to cover about. But please welcome Ryan. I do want to mention a few admin things that I always mention, and I know you know, but this is only a presentation provided for educational and informational purposes. This is not an advice in any way. We ask everyone to put themselves on mute during the presentation. Feel free to post questions in the chat or unmute yourself once presentation is over, and we can have a discussion. I'm sure there will be a lot of questions today. Our next event is on February 4th. We'll have John Kasman cover the topic of how to attract capital and clients without being salesy. We also have a few more events scheduled after February 4th. Please check out and register for them now so you have them on your calendar. We have plenty more amazing speakers coming, and without any further ado, I'd like to welcome Ryan. And Ryan, feel free to take over the stage.
Thanks, Elena. Let me share my screen and then let me know when you guys can see, because usually there's a lag between when I share it. And now that I've lived on Zoom for the last like 11 months. Awesome. Well, thanks for having me, and thanks everyone for attending. As we were just talking about a little bit, I've been doing this long enough now that I feel comfortable saying this, because I've said it enough over the last 20 years or so, that the two most dangerous thoughts in economics are this time is different and that will never happen again. So when you actually see something that's different, it makes you stop and scratch your head a little bit and think, did I actually see that? Is that actually? And 2020 was that. 2020 was actually different because we haven't really had a global pandemic in 100 years, and we've never had a global pandemic during a period where we had this integrated global economy the way that we do now. And so it was absolutely different relative to what the world has looked like previously. And so I started to think about, what does it look like when we get past this? How do we ultimately get past this, moving on to something else? And that's why I called this moving past different, because I just want to get past different at this point. Whatever the new normal is, even if it's not the old normal, I just want to get past what we've been going through for the last year or so. So this is what I want to discuss with everyone this evening. I'm going to talk about the uncertainty that we've been grappling with and how that has made things different and why that's important. I'll talk about some of the good news that we have as we start to peer into the crystal ball and figure out where the world is going. Then some of the not so good news that we have to grapple with. And I'll talk about the kind of tug of war that's going on with those things right now. We were talking about a little bit before this started, but I'll talk about how my crystal ball works and the way that I'm looking at it. And then ultimately, what does this mean for commercial real estate, right? Where the rubber meets the road. How do we think about these things from a real estate context, not just in terms of what I think could happen for the overall economy? Let's start with this idea of uncertainty. And I start with that because, hearkening back to the idea that 2020 was different, in economics, we think about uncertainty and risk as different things. And I know out in the real world, the layperson tends to use terms like that synonymously, but in economics, that's not not the case. In economics, the way that we differentiate those two things is that uncertainty is something where we lack any real quantifiable knowledge about some possible outcome, some possible occurrence. That differs from something I can quantify. Something that I can quantify, we denote as risk. For example, uncertainty abounds right now because for a lot of the reasons that we were just discussing. We haven't been dealing with a pandemic like this in 100 years, and we've never been dealing with it in the modern integrated global economy. So as good as some people have been at trying to project some of this stuff, some of it's just not knowable. There are forecasts about the pandemic that were a little more reasonable. There were some that were widely off, both on the positive side and on the negative side. Same thing with projections for vaccines. We're still finding out as of literally today that what we thought we knew about vaccines and vaccine programs and inventories and distribution is not what we thought it was. And so we're constantly dealing with this lack, this real dearth of information about things that are vitally important to forecasting the economy versus something I can quantify, right? If I want to know, I don't know, the volatility in the stock market, I can calculate the standard deviation of the S&P 500 or something like that. I've got data, I can do that. There's no historical data that's really relevant on pandemics and vaccines and things like that. We're kind of, to borrow an overused expression, we're building the plane while we're flying it right now. We're learning as we go. And just to show you that it's not just me who's dealing with this, the best way I can demonstrate that to you is to show you this slide. What I'm showing you on this slide is the range from the consensus forecasts for 2020 real US GDP growth. And I'm showing it to you over time at the point in time that those forecasts were made. So if we go back to December of 2019, the range, which I'm simply defining as the difference between the most optimistic and most pessimistic forecast, was about 80 basis points. And then we rolled into 2020 and it stayed in a pretty narrow range, 90, 100 basis points. That's pretty reasonable, even about 1 year out. And then reality sets in between March and April, and two very dramatic things happen. Number one, the forecasts shift downward from weakly positive to severely negative. And the second thing that happens is that range really widens out from only about 100 basis points, 700, 500, 600, 400. And you could see it took 8 months for that forecast range to converge back to where it was in March. And, you know, that's kind of silly, but by November, we are what, 1.5 months away from the end of the period that we're forecasting. So that's what I mean by uncertainty, that economists like myself who sit around writing code, building nerdy models, we didn't have there was no playbook for this, right? There was nothing I could pick up off my shelf that said modeling for pandemics, unprecedented 2020. We basically made the playbook up as we went. So you can see all of these economists, and these are all other, really smart economists who, have good educations and sophisticated models. It's not like they all got stupid between March and April. They just all had to grapple with a set of circumstances that, like, there's no graduate education in economics that's going to prepare you for something unprecedented like that. Thankfully, we have a little bit more transparency than we had in, say, April or May, and we're starting to wrap our minds around this a little bit more. We have better data about the pandemic itself. We have better data about where we think we're going in terms of vaccination, even if we're not getting that stuff exactly right. 6-8 months ago, we didn't even know if we were going to have vaccines. So try modeling the economy if you have no idea if you're going to be able to get people out and about again. Thankfully, we have some idea of the proverbial light at the end of the tunnel. So let's talk about that a little bit. I want to talk about some of the good things that we know with a little more clarity now. I'll talk about some of the bad things also that we know with a little more clarity. The first thing that's good news is we got the election behind us. And I say that as a very politically agnostic person. Just removing the uncertainty of the election is a good thing, because uncertainty is a paralyzing force in the economy, because people don't want to make mistakes. People don't want to choose the wrong course of action. And the policy differences were stark enough that, and I can tell you firsthand, talking to a lot of big, sophisticated institutional clients over the last year or so, a lot of them were waiting to see what happened with the election to make a decision. I know a lot of people personally who were waiting to see what happened with the other side of the election, and probably dragged on a little bit longer until we knew the outcome of the Senate runoff races. But either way, just getting the election behind us is unambiguously a good thing, because it frees people up to actually start making decisions. The other thing that happened is, and I know I'm still calling it divided government, because when you need the vice president to break a tie, like, that's still divided government, right? So if, as I said to a friend the other day, I said, if the Republicans are holding a pair of sevens, the Democrats are holding a pair of eights. It's not like they're sitting on a full, a full house or a straight flush or something like that. Their margin for error on policy making, even the few things that can pass via reconciliation with a simple majority, even there, they're going to have a hard time, because some of those Democrats come from very right-leaning states. They're not going to countenance everything. Even just the plans that came out last week, that $1.9 trillion plan, to me, that's more of a wish list, a starting point for negotiations, than something's going to happen. And I could say the same thing, probably even stronger, about potential changes to tax laws and things like that. So I still see that as a good thing, because it means, if anything, we will get marginal changes in policy, probably ones that benefit the economy in the short run, like spending. I don't think you're likely to see highly disruptive, transformative policy, if for no other reason than it's going to be hard to get 60 senators on board for anything that can't pass via reconciliation. And even the few things that can pass via reconciliation, which are basically spending, revenues, and debt levels, even there is going to be a harder slog than I think some people are expecting. So I see more marginal changes on the policy level, rather than massive radical change like the Affordable Care Act, which I'm not taking a political stance on. I'm simply saying I don't see that kind of legislation being passed anytime soon, at least not till the other side of the midterms. The other bit of good news is that, yes, we do finally have vaccines. It's been disappointing in terms of, I think, the rollout and how quickly we've been getting people vaccinated, but at least we can have this conversation, because 4, 5, 6 months ago, it was still uncertain as to whether or not we would be able to talk about this. And I think the thing about vaccines, the way I've been explaining this to people, is that this is not going to be a binary outcome. It's not like somebody flipping a switch and all of a sudden everybody's going to start roaming free again like it's 2019. This is going to start slowly, have very small marginal impact at first, because too few people are going to be vaccinated relative to the size of the population. But these benefits will start to accrue and accumulate over time. As more and more people get vaccinated, as they feel more comfortable going out and about, they will start to re-engage the economy more than they're willing to do right now. The other thing that's going to happen is that as vaccinations ramp up and you start to see case levels come down and hospitalizations come down and fatalities come down, even the non-immunized will start to feel at least relatively more confident. Not as confident, obviously, as somebody who's been immunized, but I can tell you, as someone who has definitely not been immunized yet, when case levels were low, I felt a little bit better about being out and about, not in an reckless way, but reasonably okay. Now with case levels at really high levels, I'm not as confident about that. I'm a little more cautious about that. And I know I'm not the only one, because again, I'm having conversations like this all the time. There's good empirical evidence, studies to back that phenomenon up. So slow at first, but eventually you will start to see this have, it's almost like it's like a nonlinear function, right? I'm sorry, I don't mean to go all math on you for a minute, but the impacts start slowly and then they accumulate and they ramp up. It's not as if this is going to be a perfectly linear thing. So starting very slowly at first, accumulating over time, and then eventually reaching critical mass, where I think we'll start to unleash a lot of pent-up demand for economic activity. The last thing is that we did finally get one more stimulus plan at the end of last year, after all of the horse trading and wrangling that they had to do, and eventually getting the former administration to sign it. We shouldn't go through all this. My point in showing this is just to say this, I thought, was important, because the main issue that I have with this downturn and why it's different is that because there's a supply side and a demand side impact simultaneously, the economy can't self-correct the way that it normally does. You have supply side impacts by government officials locking down, shutting down certain parts of the economy. That's not going to change until the pandemic gets better. And then, as we were just talking about, you have a demand side effect where certain people are just not willing to do certain things, right? There's no there's no government edict that says we can't get on an airplane right now. But if you look at air travel levels, even with the run up that's occurred, they're still down dramatically from last year because most people don't feel comfortable doing that. They're not really excited about staying in hotels. Most of the places that they go, they don't know what's going to be open and what they could even do. But yet there's nothing that says you cannot get on an airplane right now. So both the supply side and the demand side are taking a hit that just can't self-correct, because neither of those things are going to go away without getting past the pandemic. The supply side shock doesn't go away until we get past the pandemic, and that demand side shock will not go away completely till we get past the pandemic, which is why, even as a pretty laissez-faire, market-oriented economist, I think government support is vital right now. Because think about it this way. This crisis started February, March last year. We're still net short 9-10 million jobs. We're still seeing weekly unemployment insurance claims that are higher than anything that we saw during the financial crisis. This is not getting better on its own. We're going through fits and starts periods, but until we get past this, the normal self-corrective measures in the economy, things like price elasticity of demand and things like that, they're not going to work. Because if you think for example, getting on an airplane potentially puts your health at risk, then there's no price point at which it's going to incentivize you to do that, right? There's a pool of people, I don't know how large, that's going to say it's not worth it to me, right? I'm sure there's some pool of people that says, hey, you know what? We might die in 2 weeks, but these flights are so cheap. Let's go to Hawaii, right? There is some group of people willing to do that, but there's a large enough group of people that is not willing to do that. And so I'm glad we got this package. We will probably get another one. I think it'll be closer to another $1 trillion than $2 trillion. But until the economy can get past this, which I don't think is possible till we get past the pandemic, I think government support is going to be of paramount importance for this. On the flip side, the data is what it is. The pandemic is worsening across a variety of metrics. And even though people want to talk about, percentage changes in things like fatality rates, on an absolute basis, which is what scares people, case levels are hitting record high levels, hospitalizations are hitting record high levels, daily fatalities are hitting record high levels. That's the kind of thing that keeps people on the sidelines and out of the economy. So as much as it's great that I think the health outcomes are better relative to last year, because we know more versus about the disease itself than we did last year, that's not going to get people out shopping again and going to bars and restaurants, right? Just because the probability that you might survive is greater than it was, the fact that there's still more of this circulating out in public is causing government officials to take extreme measures, and it's causing people to opt out of a lot of things. So the fact that the pandemic has gotten worse, which I was generally baking into my forecast, even though the numbers are really hard to pin down, that is a limiting factor right now. It's one of the reasons why, well, I'll show you. It's one of the reasons why we're getting headwinds in the economy right now. And I could have shown you any number of metrics to demonstrate that, but I like this one, labor force participation, because it gives you a sense that we have hit a bit of a plateau in the recovery, that the labor force participation rate has been stuck in a very narrow range between about June of last year and then the end of last year. We got a nice bounce back over 2 months or so between April and June, but we've been kind of undulating a little bit since then. And I could have shown you job creation, which turned negative again in December. I could have shown you any of the inflationary measures, which are struggling again. I could have shown you the newly elevated rates and weekly unemployment claims. We are definitely getting to a period where I think, even though the economy still grew in the fourth quarter, there have been more headwinds building lately than we saw, say, summer into the fall, when things were starting to turn around a little bit. And so that's why I'm a little concerned about this becoming an impediment, and why I think that the spending packages, at least on a short-term basis, are important for the economy. Then the last thing is, honestly, the Fed is just out of ammunition, and at least in terms of what matters. It's not that they can't do anything. I think the Fed has done an incredible job of keeping the financial system operating well. But the issue is, and the empirical research backs this up, the single best weapon that the Fed has for stimulating the economy and blunting the impact of a downturn is cutting interest rates, right? All of the quantitative easing and all of the other things that they've done, which I would argue are more credit policy than monetary policy, I'm not saying they don't have any impact, but the single best thing the Fed can do is just cut rates. And they've gotten to the point where they can't really cut any further. I mean, even at the long end of the curve, when you're talking about 10-year treasury rates inside of 100 basis points, which is usually where we think of the, the Fed funds rate as being, the Fed just doesn't have a lot really they can do. They can maintain pretty well, but I've been trying to get people away from the idea that as great as central bankers have been over the last 20 to 30 years, they're not superheroes. They're not flying around with capes on. Like, we need to have fiscal policy as a reasonable part of the economic toolbox and not just be overly reliant on central bankers to bail us out every time we get into a crisis. And my concern is that since we've largely already used the main weapons in their arsenal, any additional things they can do would be more incremental. They would not have the same kind of impact that something like cutting rates would have, especially because I think the experience of going negative on interest rates has shown it's probably doing more harm than good, because what it does is it keeps firms like zombie firms alive that shouldn't, because if you don't have to pay interest, it's easier to stay in existence. You become a productivity drag on the economy. You're not doing anybody a benefit in the long run. And it's hard to incentivize savers to go out and put money into accounts when you promise them less than they deposited once they put their money in. And so the Fed is kind of at the effective, zero lower bound. They really are kind of stuck there. So I think the Fed is doing a great job of managing the financial marketplace, and they're supporting the economy as much as they can. I just think we've reached a point where their ability to, they can have additional impact, but at the margin, it's definitely going to be smaller than what they were able to do last year. So what does that mean for us? It comes back to this idea that the pandemic is the recession, that those things are not independent of each other. I think there, at least for enough of last year, there was a group of people that thought they were like a Venn diagram that didn't intersect, that they were just two circles sitting next to each other. And that's not the case at all, because if we didn't have this pandemic, we wouldn't have gotten into a recession, at least not in February into March. And so what's going on right now is that there's a little bit of a tug of war between what I'm calling the response mechanism and then this feedback loop. So when I say response mechanism, I mean all of the things that we can do to keep the economy stable until we really get past this. Partially it's fiscal stimulus, spending money. Partially it's monetary policy with the Fed. And then it's, to a large extent, the vaccination program. And that is just going to take some time. How long, I think, remains to be seen. But those are the kinds of things that we need to do to either support the economy while we're getting through this, or to actually get us through this. Because I'll show you in a minute, we're entering a really strange period. Hold on to that thought. I promise I'll come back to it on the next slide. What's pulling against that is what I'm calling this feedback loop. The idea that our behaviors are causing the pandemic to worsen, right? Because if we, again, and I'm not making a political statement, but if we were abiding by all of the medical advice, all of the healthcare provider advice, then we wouldn't see this kind of trajectory, right? This doesn't happen randomly. This only happens because people are doing certain things. So because we were not taking advice on not seeing people for Thanksgiving and the holidays, because not everybody wants to wear a mask, not everybody wants to social distance and those kinds of things, that's a consequence. And so it's had a consequence in two ways. The first way, obviously, as I just showed you the data, it's caused the pandemic to intensify again to record levels that we had never seen even back in the spring, which was the previous apex of this. It's also changed what I'm calling the political state of play, because it forced the hand of certain government officials to start, locking down, shutting down certain parts of the economy again. And so what we're really hoping for at this point is to get through this period where those response mechanisms, especially the vaccines, can pull us through this before the feedback loop starts to get any worse, right? And so that's really what's happening. Can we start to inoculate enough people to head that off at the pass, to start to bring the case levels down while people's behaviors are keeping the case levels at record high levels? And that's really where we are, right? We're in a different place, but we're back to the same theme, that we need to get past the pandemic if we are going to get past the recession. And the only way that I can see through to that right now is if we start vaccinating people and then people feel safe enough to go back out and re-engage the economy, because that will have benefits to the economy and the commercial real estate market. So we're talking about how I'm reconciling this. If for those of you who are not acutely listening to that conversation, let me walk you through that discussion. What I've had to do is, because a lot of these things are non-economic in nature, I had to just start making up assumptions about them, especially on the health side. Not so much explicit assumptions on the economy side. Things like government spending required explicit assumptions, but about case levels and vaccination and social distancing and compliance and lockdowns and those kinds of things that are not purely economic in nature. And so, as I was saying before, what I did was I gave my model just a whole slew of assumptions. I had to write a whole extra subroutine in the code, which I never had to do before. And I just let it run all the different permutations and combinations of these things. What if the pandemic does X and vaccination rollout looks like Y and government spending looks like Z, and those kinds of things, and just run thousands of simulations. And then there was no good way for me to show you thousands of simulations. And so what I did at the end of the program is I wrote a subroutine that basically looked for what I'm calling convergence. Among the thousands of scenarios that the program was running, were there kind of centers of gravity where you started to see clustering, if you will. I knew it wasn't going to be a uniform distribution just by how the pandemic was playing out, but I asked it to look for centers of convergence. And thankfully, it's generally centering around three things, which I'm kind of showing you on the slide here: a base case, an upside case, and a downside case. And so my point in showing you this slide is not so much that we should go through this one bullet point at a time. I just wanted to give you a sense of the kinds of things that I have to grapple with now that I never had to think of before. Like I said, I didn't take a class in graduate school on, pandemic econometrics, right? There was no such thing. Like, there was no such class. We've had to figure this out as we've gone along. And so I've had to do a lot of learning over the last year, right? Making assumptions and testing models and seeing what, unfortunately, I only have, as far as GDP, I only had, one real quarter at this point, but trying to refine it based on other metrics. How good was it projecting what was going on with the job market and the labor market and inflation and interest rates and all other metrics that come out on a more frequent basis than just quarterly. And so I've been constantly refining this, and I think it's getting better, but I will be the first person to tell you that this is still very assumption dependent, and to an extent, assumptions are in the eye of the beholder. And I think even today, you will get differing opinions on where the pandemic is going, when we're going to get vaccines, when we can start to go back about our lives and travel again and eat out and see our friends and hug grandpa and those kinds of things. There is still no consensus on that, because even today, I heard Dr. Fauci say that he, not that long ago, said everyone would be able to get vaccines in pharmacies by April. And now he's like, I don't know, but it's not April. So if he doesn't know, I definitely don't know. And I'm not going to profess to know more than he does. So let me show you what this has produced. So what I did was I just ran the simulations to see what it looked like. And so something, as I mentioned previously, something very interesting is showing up. So you could see basically from last year where we went, you could see there was the 5% annualized contraction in the first quarter. You could see that annualized contraction of 31.4% in the second quarter, which is the single worst quarter in economic history, dating back to 1948 when we started keeping quarterly records. The good news was that is followed by the best quarter in economic history in the third quarter of 2020, when we got 33% on an annualized basis. But that's already in the past. The more interesting part is, where do we go from here? And so that's where, again, things get interesting. And what I wanted to show you was thinking about the next 6 months or so versus the longer time horizon, because it's that next 6 months where that tug of war that I've been discussing is going to play out, those positive factors and those negative factors. And that's where I have the most uncertainty, because I just don't know, right? Like I said, if Dr. Fauci doesn't know, then I definitely don't know. And I'm not going to profess to know more than he does. And I find that really interesting as an economist, because usually when I think about modeling and trying to peer into the future, the further into the future we go away from where we are today, the less confident I feel about forecasting, right? So for those of you who are a little more finance oriented than economics oriented, the further away we get from time zero, generally speaking, the more uncertain people feel about forecasting, right? Most people who do like corporate, if you're a sell side analyst, you probably feel more confident forecasting revenue growth over the next 12 months than you do 120 months down the road. Same idea if you do econometric modeling. I feel better about my forecast 12 to 24 months in advance typically than 36, 48 60 months out in the time horizon. But that's not really the case this time around. Not so much that I feel more confident down to the basis point, but I feel confident once we get through this 6-ish month period that the economy is going to start to grow again. I think it's just a question of how fast it starts to grow. What I don't know exactly is what the path looks like over the next 6 months, because it's hard to forecast the pandemic. It's getting really hard to forecast vaccination. Like I said, even today, the news is different relative to what it was like a few days ago. And understanding how quickly we can get to that level of herd immunity and start to move past this. Again, it's kind of assumption dependent. So if you think that we are going to roll through this relatively quickly, we'll all get vaccinated by the summer and then we'll all be on the beach together kind of thing, then you probably like the black line, the more optimistic one. If you think vaccination rollout is going to take longer than we even think right now, that manufacturing and distribution and administration is going to continue to fail to meet targets, maybe you feel more pessimistic about this. And if you're kind of Goldilocks on this, you're not too hot, you're not too cold, then something in the middle, that red line, is a little more your speed. But it's really that kind of 6-month window between the end of last year and I think the middle of this year, give or take a month or two, depending upon how vaccination goes, where we're just going to have a wait and see approach to this and see how it plays out. I think we get on the other side of this by the third quarter. And then I think we unleash a ton of pent-up demand, a torrent of pent-up demand, and then we're off and running for a while. It's just that it's that 6-month window that we really have to get through. And the good news about that is, unless we really get the downside scenario, we're probably out of the technical recession. My base case, at least, thinks we're out of the technical recession, even if growth is not, it's not exciting. It's not hyperbolic in the first half of the year. And so that raises a good question, right? Well, why is that the case? Is it simply by dint of mathematics and my model crunching numbers? And I'd say, well, it's not just the math. As much as I love math, it's a little bit more than that. And I want to show you this slide. This is every recession in the United States from the Great Depression forward, measured in duration by months. So you can see I've got them all on there, and I calculated the average, the arithmetic mean average. It's about 13 months. But if you look closely at the slide, you will notice something, that there are only 4 downturns that exceed that average. There's the Great Depression in the late 20s and early 30s. There's the oil crisis recession of the early to mid 1970s, which I was only technically alive for the end of, but my parents like to remind me was thoroughly unpleasant to live through. There's the second Paul Volcker-led recession of the early 1980s. And then there's the, I got to start calling that something else, because that feels like the not so great recession after this. I think we were a little too quick to name that the Great Recession now that we've been enduring through this for the last year or so. But the thing that those 4 downturns have in common that the others do not is that those were all financially oriented downturns. There was some severe disruption to the financial system, whether it was obviously the stock market imploding and the Great Depression and bank runs. And I think we've all heard about that from someone or a textbook somewhere along the way. The oil crisis recession starts as a geopolitical event that spills over into oil markets and commodity markets, that spills over into financial markets, that cause that to be longer than it would otherwise be. The second Paul Volcker recession of the 1980s, look, if you're going to raise the Fed funds rate, which is now basically sitting at 0, up to like 19, 20-ish%, like you're going to have a severe disruption to financial markets. So that's not a surprise. And then obviously the not so great recession that we lived through was a financial disruption centered on the residential real estate market here in the US. You get away from those and you get these, well, they're not pleasant recessions, but they're more plain vanilla. They're shorter, they're shallower. They don't cause as much damage. They don't last as long. And think back to what I was saying with the Fed before. The Fed has gone out of its way to support the economy. So unless you think that somewhere between now and when we get past the pandemic, that the Fed loses control of the financial system, there isn't a really good reason to think that even if we hit a bump in the road here and there, that at a minimum, we're not past the worst of this, and we're very likely past the technical recession phase of the downturn. That raises the question, well, what does the recovery look like, right? What does it look like on the other side of this? And that's where you get something that doesn't look like anything we've exactly experienced recently. What I'm showing you on this slide is my base case trajectory. I benchmarked it so I could make an apples to apples comparison. So the red line is my base case for whatever we end up calling this recession, versus the S&L recession of the early 90s, the dot-com recession of the early 2000s, and then the not so great recession that we lived through not that long ago. And you can see it's kind of in between those. It's not as quick of a bounce back in GDP as we got, certainly with the dot-com recession or even the S&L recession, but it's not the kind of prolonged pain that we got out of the Great Recession, where it took like a year and a half or so for us to just like get. It was a mess. I don't even think there's a way for me to emphasize. It took more like 14 quarters, approaching 3.5 years to gain back all of the GDP that was lost during that downturn. So this is kind of Goldilocks. It's hard to see on the slide, but it's about 8 quarters to get back to break even on GDP, which again, not as rapid as say the dot-com recession, but not as prolonged as the Great Recession. So why is this relevant to us? Well, it's relevant to us because what we're getting right now is, in keeping with this theme that it's different, it's kind of unique. It's kind of a hybrid of past recessions, at least in my base case. So what do I mean by that? If I take sort of the major components, the way I think about downturns, if I take the contraction in the economy, how much it pulls back, it's pretty severe. On a peak to trough basis, it's about 10%. That's the worst performance that we've seen since demobilization at the end of World War II. So in most of our lifetimes, we haven't seen this kind of severity in contraction in GDP. But then going back to what I said about the turnaround, I think it's pretty quick. Growth resumed in the third quarter. I'm cautiously optimistic that we'll get a pretty good growth reading in the fourth quarter. And then we're at that uncertain period. And I think maybe we hit a bump in the road. But I at a minimum, I would say the worst is behind us, that we are in recovery phase. The real question is how quick it is and how strong it is. And that brings me to the recovery phase. And I elongated that green arrow to emphasize this point, that even though it's a quick rebound, I think, in the economy, it's not a quick recovery back to where we were when we started. So if we take those 3 components, the contraction, the turnaround, and the recovery, you get this Frankenstein's monster of a recession that doesn't consistently look like anyone we've had in the United States up to this point, but has certain characteristics of other recessions, right? Some look like deeper recessions, some look like shorter recessions, some look like something kind of in between, but we don't have anything that looks consistently like the kind of recession that we've ever had up to this point. And that's why I say it was different last year. But I think undoubtedly we are in that green arrow. We are on the road to recovery. It's just a question of getting through that 6-month period and getting to the other side of this, which raises the ultimate question: what does this mean for commercial real estate? Because this is what I ultimately care about, given what I do for a living and anybody else who's even remotely interested in it. And this is where I think we have to admit there's some things that we just don't know yet, and there's some things that we do know. The things that we don't know are what I'm loosely classifying as being structural factors, things that could potentially change on a permanent or semi-permanent basis. And I don't think we should go through this one property type at a time. I'm happy to answer that in questions, but things that we were not having conversations about before, right? Is work from home a permanent thing? Are people going to telecommute? How often are we going into the office? Are we going to get de-densification of space? Will we use flexible space from the WeWorks of the world on a more frequent basis? If anybody tells you definitively they have the answer to that, the first thing you should do is stop listening. And the second thing you should do is walk away from them. Because I am having this conversation with clients on a weekly, if not daily basis, and they don't know the answer to this stuff yet. So if the biggest users of space and the biggest institutional investors in space do not know the answers to this yet, then the average random person telling you they know exactly what's going to happen doesn't know the answer to this either. The one thing I can say definitively is that there's not going to be a one-size-fits-all solution. There are going to be a variety of solutions to that question, and we're just going to have to see how that plays out. Same thing with other property types. I think, the increase in e-commerce that probably accelerated that trend, but whether or not we're still all just shopping at home and not going out after this, I'm not so sure that's a thing. We'll have to see that plays out. The increased use of things like third-party logistics firms really ramped up during this crisis. We'll have to see if that sticks around on the other side of this. And again, same things with like retail, people going back into stores, apartments, whether or not you're going to continue to see the home ownership rate tick up and people moving out of city centers into suburbs. I have my views on all of that stuff, but that's not what matters to me for this purpose. What matters to me for this purpose is that I can break out those structural factors and I can still look at the cyclical underlying dynamics in this. And by that, I mean just the relationship between commercial real estate and the macroeconomy as we go through cycles, because this has been well established through the real estate data going back at least 40, 45 years through multiple multiple business cycles. And I'm supremely confident in saying that pro-cyclical behavior between all of these property types and the macroeconomy is still intact. And I'm already seeing this in the data, that this relationship. So unless you think, and I don't, but unless you think that there's some serious change, some serious damage to the economy that causes GDP to stop growing, or the labor force to stop growing, or employment to stop growing, or population growth to stop growing, or the household formation rate to turn negative, then there's no good sound argument that says we won't continue to get a cyclical relationship between these things and the overall market. And that's heartening to me, because even if I can't tell you exactly what's going to happen with work from home, I am confident in the fact that the economy will continue to grow. We will put more people back to work. A lot of those people will still use office space. They will still commute. And I feel confident in saying that there is going to be a recovery in commercial real estate, likely bottoming next year. It'll differ a little bit by property type and by market, but aggregately bottoming next year and starting to bounce back. And I think, like a lot of the past recoveries, once we go through that tentative period where rents start to grow a little bit and vacancies start to stabilize, I think a lot of that pent-up demand that's going to come through on the part of corporations and households is going to filter through to these different property types. I think it's really just a question of, at the margin, how do some of these structural factors change the landscape? But I don't think that's the death knell for commercial real estate by any stretch of the imagination. So just a few takeaways. Vaccines are the best way for us out of this tunnel. That light at the end of the tunnel, like, that's it. If there's some serious, I don't want to jinx it, but if there's some serious issue with vaccines and they really go awry, there's no plan B for this. It's back to the drawing board for more or different vaccines, because there's no other good way you're going to drag everyone out of their houses again. That is probably the worst case scenario that I could conceive of. I do think that the risk is really concentrated in the next 6 months or so, give or take. We get through the next couple of quarters, and I think you get most people vaccinated and most people are back out and about spending money in the economy again. Businesses are starting to invest. They're starting to hire people back. They're starting to produce more things. And I think that could roll for a while. And that leads me to my overall outlook being positive. I'm generally bullish on the economy on the other side of this. I think that translates into a lot of cyclical demand for property types. And I think once we see how some of these structural factors play out, we'll have a better sense of what the structural impact is going to be on demand. But either way, I running all of my scenarios, I don't produce any scenario which doesn't show demand going up, doesn't show vacancy rates coming down, doesn't show asking and effective rents starting to increase again. It shows cap rates going down. It shows values going up on both an aggregate and on a per square foot or per unit basis. So fingers crossed, we get through the next 6 months without it becoming too dicey. I think the economy starts to accelerate. Commercial real estate usually lags the economy by about 12 to 24 months generally. So if the nadir of the economy was in mid 2020, which I feel pretty confident about at this point, then hitting the bottom sometime in 2022 feels right to me. And then I think we're off and running again through the next 4 to 5 years of my forecast horizon, which gets us to the middle of the decade. And I think it could last longer than that, but I don't forecast beyond 4 or 5 years, because you might as well throw darts at a board beyond that point. But at least through 5 years out, vacancy rates are still coming down, rents are still going up, and I think there's still good opportunities to be made in commercial real estate. And that's all I got for now. I'm happy to take any questions that I couldn't address during our riveting presentation this evening.
Wow, Ryan, that was jam-packed. Thank you so much. It was definitely amazing presentation. And I'm sure we're going to get a lot of questions. Folks, again, feel free to type in or ask. I want to start by asking, do you think there will be an impact to the rates? Do you think Feds are going to change the rates again in the direction?
My thought on that is they'll be cautious for a while. And I think if you take them at their word with the new framework that they've put into place, where they'll let inflation run hot for a little while. Hot is I'm using that a little bit liberally. I mean, we're struggling to get to 2%. So hot's not what it once was in inflation. But my thought on this is, if you think about the last cycle, the Fed cut to zero in December of 2008, and they didn't raise again until December of 2015. I'm not saying we go 7 years, so I'm not saying 2027. But I think the Fed learned some lessons from that. I think they're probably going to err on the side of caution. So at least at the short end of the curve, I think we have at least 3, 4, 5 years before they start pushing on that. I think the long end will start to move up on its own, especially as growth reaccelerates and you start to see a little bit of inflationary pressure come back. So to me, that means that the yield curve will probably start to steep. I mean, you've already seen it steepening. I think it will probably steepen further. But at least at the short end, I think the Fed is going to be circumspect for a while because I think they're going to want to see that not just GDPs come back, but the labor, maybe not full employment because that's such a squishy concept, but significantly more strength in the labor market than we've seen over the last year or so. That leads me to think it's probably toward the middle of the decade before they decide to move again. But I think the bond market at the medium to long end will move on its own once they start to see the economy snapping back and inflation ticking up a little bit.
And when you say bond, do you mean long-term bonds?
Yeah, 10 to 30 year out, you know, the 10-year treasury to the 30-year. I think that part of the market will respond faster. I think the short end is going to be held down by the Fed because I just don't see the Fed moving, at least not in the reasonable future. It's going to take a lot more strength in the economy before they're going to feel comfortable. You know, a few Fed governors rattling their sabers notwithstanding, I don't think there are going to be nearly enough votes for that until the labor market's in a much stronger place.
Thank you. Ryan, in one of the earlier slides that you had where you talked about the different opinions, you know, the most optimistic versus the most pessimistic, you said that the range of, you know, different opinions lasted for about 8 months until it subsided back to that 10 points. And obviously there was significant economic impact. Do you think some of it has been impacted by the politics as well, the fact that there was a turmoil with the elections and all?
Yeah, I think removing the uncertainty around that mattered because even without perfect transparency on policy, at least you narrowed the range of possibility, right? Because before the outcome of that election, and again, I'm not a political person, but the policies that you were likely to get from this administration versus the previous administration are, they almost couldn't be more stark, right? I mean, you've already seen in the first, I don't know how many, 20, or what, 32-ish hours of, I'm ballparking it a little bit, but the first 32-ish hours of this administration, I don't know how many executive orders they've gone out and signed reversing a bunch of stuff. And not that executive orders are legislation, but those things matter economically, right? It's not just, and this is a point, that's a good question because it's an important point that I make to people. It's not just legislation that matters for the economy. Things like trade policy matter for the economy, and you don't often need Congress for that. Things like immigration policy matter for the economy, and you don't often need Congress for that. So that's an important point that I think people overlook. People tend to think of executive orders as being these kind of, you know, like small things that don't matter. And maybe relative to $2 trillion spending plans, that might be true, but they still matter for economic reasons. And so that's why I think just getting the election behind us, irrespective of the outcome, provided more transparency for people who have to do what I do for a living.
Great, excellent. I see some questions pop up. So what are your thoughts on wage depression, which may be a damper economic participation?
Yeah, you know, wages are one of those things that you know, the shame about this downturn was that we were finally starting to make progress on not just wages in general growing faster, but narrowing not the gap, right? I mean, like, I'm still not making as much as LeBron James is, but the rate of change was starting to converge. You were starting to see people in the lower wage distribution starting to accelerate relative to people in the higher wage distribution. The shame of this is this really disrupted that. My concern about this is that while I expect the economy to grow, and I do think that we will head to a higher growth rate in the latter half of the year, this is producing a lot of permanent damage in the economy. The hysteresis that you always hear economists talk about. There have been permanent job losses, there have been permanent business losses, and you've had a bit of a cultural change because with children largely having to do school from home, it's largely been women who've been forced out of the labor force because they're the ones who generally tend to be responsible for childcare. And so my concern is even that becomes a more structural impediment, because if they're out of the labor force for a while, it's generally difficult to go back in. And even if you do, there's almost always permanent damage associated with that in terms of wages and wage growth and climbing the corporate ladder and things like that. So I think we can eventually move past that, but I think it would be irresponsible to say that we can simply gloss over this permanent damage and that it won't have any lingering effects. I think for a while it will have a lingering effect, and you've already seen that in the data. Just to give you an example, during this downturn, the wage growth data accelerated, but it only accelerated because of a selection bias phenomenon, because the labor pool wasn't consistent from period to period. What we were doing is we were removing people whose wages were not growing and leaving behind the people whose wages were actually growing. That's not a place that you want to be. That's my concern about this.
Sure. Ross is saying, I read an article that passing 1.9 billion stimulus may actually hurt the economy. Is that a possibility?
In the short run, I think there's such a big hole that's been left by consumer spending and by business investment that I think it's a benefit in the short run. I think in the medium to long run, like, we have to be careful about this, that we can't just use this as a blank check or like an unlimited credit card. I think it would benefit us in the short run, undoubtedly. But I think in the medium to long run, it accelerates us toward a point where we're going to have to think a little more seriously about our outstanding debts and deficits, because this is a problem that's been, we've been kicking the can down the road for the last 60-ish years, since the early 1960s. At some point, we're going to have to get serious about that. This could eventually become a drag on growth. I think in the short run, though, we have such an impairment to aggregate demand, and the economy is not going to fix itself on its own. I see it doing more good than harm, but in the medium to long run, there's an argument to be made that this could ultimately do more harm than good, and so we're going to have to be careful about that.
And do you think that could potentially cause devaluation of money as well?
It's possible, because the easiest way out of that would just be through inflation, and which would obviously, unless you're in an inflation hedged asset, it could easily start impairing that. And that's how we usually get ourselves out of things like this, right? So whether or not you think we've technically defaulted or we haven't defaulted, that's not a debate that I want to wade into. I'll let the economic historians fight that out. What I'm simply saying is, whenever we've had issues like this, we've tended to inflate our way out of it. That would probably happen before we outright defaulted on $22 trillion worth of bonds. We would probably reflate our way out of it. And that means, assets that do well in a higher inflation environment would probably outperform. Ones that struggle, like fixed income that aren't tips or something like that, would probably, would probably have a harder time with that. And that isn't a, 3 or 4 year phenomenon. I don't know exactly what the time frame on that would be, but at a minimum, we are putting the pieces on the board potentially to have stronger inflation than we've seen in 10 to 15 years. Some of the factors are non-economic. They're a little more political, like we were talking about, like supply chains and things like that. But at a minimum, we are putting those pieces into play. Whether or not those pieces actually get played on the board, we're going to have to see, because those are more, political, geostrategic decisions. But the possibility's there, no doubt about it.
Got it. Assuming vaccines are all delivered and working, what are your thoughts on GDP recovery?
Let's say, for argument's sake, that we really can start vaccinating people, and that by, say, the middle of this year, we've gotten past 70%, 80%, and we've gotten a herd immunity, and this is largely behind us. I think that if we can accomplish that by the third quarter, I think the third quarter could be great. It could be 5-6% annualized, because I think there's a lot of pent-up demand that is screaming to get out. I don't think that's sustainable on a permanent basis, but I think from whatever that snapback quarter is, whether it's the third quarter or the fourth quarter, I think the economy can run hot through 2021, even into 22. I'm sorry, through 21 into 22, and then even on to 23. I think by 24, toward the middle of the decade, reality starts to set back in, and we start to converge back toward capacity, which based on demographics and productivity growth is probably 1.8% to 2% real GDP growth. But I think we can run ahead of that for a while, partially because pent-up demand will be released, and partially because I think on the other side of this, both households and businesses are going to make different decisions at the margin, some of which could be really good for productivity, especially technology, automation, things like that. So we get through this. I think there's a good 12, 18-month, 24-month period where we can run ahead of potential. And I think that would be great for the economy. So I don't want to overpromise and underdeliver, but I'm feeling better about that. We just got to get through this last dark stretch and getting everyone vaccinated. And I think as long as something doesn't go wrong, I think we're off to the races for a while.
Don't you want to get your crystal ball back up and running and just tell us what's going to happen?
I do. I really want to stop talking about, how vaccinations impact GDP and how case levels impact GDP. I mean, I want to get back to the boring stuff, right? Like labor markets and whether or not, people are still immigrating, and whether or not automation and AI is going to really improve productivity growth. That stuff is still there. It's hard to have a conversation about that when things like the pandemic and vaccines are the overriding factors right now. It's because those are the ones that are really driving things, unfortunately.
For sure. And that drives manual manipulation of the formulas and all the evaluations that you do. You can't really use the tools the way that they are right now, because there are so many surrounding factors that were not predicted and not assumed are in a tool.
Yeah, if the world's best epidemiologist can't tell you exactly where this is going, then I can. And that makes it hard for me to know discreetly what's going to happen in the economy. Like I said, the best I can do is run thousands of simulations, give you a few scenarios, show you what general growth vectors look like. But beyond that, it's really hard for someone to have confidence in their forecast down to the basis point. It's a really challenging time for this kind of exercise.
For sure. Okay, the questions are piling up, so let me get on to it. If and when dollar value declines, wouldn't it be better to invest outside of US?
Even now, I'm a believer investing outside the US. I think there are still good growth opportunities in other parts of the world. I think the relevant question to that is, do you hedge the currency or not? And I think that sort of depends on your outlook. If you are someone who thinks there are good opportunities outside the US and you think you can generate good returns just on the merits of the investments, then maybe you don't roll the dice on hedging the currency. If you're someone who likes to benefit from the currency trade, then maybe you don't hedge and you let it ride. I say this personally, not just professionally. Like, I'm constantly investing outside the United States, in Asia and Europe and Latin America. There aren't too many parts of the world that I'm not willing to invest these days. I tend to not hedge the currency because, in my experience, I think individual currency movements are not correlated. I can control when I repatriate that money in a lot of these instances. So if the exchange rate doesn't look favorable at a point in time, I can delay that decision. So I tend to not want to pay for the hedge because that costs you money. And like I said, I'm investing in enough places and enough different currencies. And I'm the one who's basically controlling the buy, hold, sell decisions. If the currency just happens to look bad at a point in time where I might otherwise close the trade out, I just wait a little bit longer, right? Because as long as the merits of the deal are still there, I'll let it sit for a while. If I get to a point where it's a mess and a loss is a loss, I'm not afraid to do that. But that's where I think control matters, when you don't have to, when your hand isn't forced, and you take gains off out of your portfolio in other places, rather than force your hand on a currency trade that moved against you or something like that.
Yeah. What is your time horizon estimate on getting back into CRE REITs?
I think you're probably better off to be, if you really want to capitalize on this, to be sooner than later. So I'll tell you the same thing I'm telling my clients right now, is that unless something goes really wrong, that there's going to be a pickup in the economy in the latter half of the year, and that commercial real estate is going to follow suit. So even if you're not willing to make a decision about space till we get through this uncertain period, you should be thinking about it, right? So I've been telling them, start game planning, start modeling, thinking about what you want to buy, what you want to lease, what you want to sell, what you want to refinance. So my thought on that is things are probably going to be quiet while we get through this period. And then I think there's going to be a 6-month period after that where people are trying to feel their way through. If you don't want to be a first mover, you don't want to catch a falling knife, I'd say wait a little bit longer. But I think by the latter stages of this year, people are going to be back to making serious commercial real estate decisions. And I think at least various corners of the REIT market are going to start to recognize that and start to move a little bit. I think it will differ by property type and geography, but I think we're still in a quiet period through the middle of the year. But I would expect the people who want to be in the vanguard of making real estate decisions to start doing that in the latter half of 21. And I think eventually even the REIT market is going to start to see that and benefit from it.
Excellent. In your economic forecasting, which variables have become much more important, critical during the pandemic, and where they perhaps were not material before?
One of the weird things about this is that because this is so unique, what it's really done is it's caused a lot of the normal ways, I'm using that a little liberally, but the normal ways to think about forecasting, not that they're permanently impaired, but it's just tough. Like it's hard for me to look at it and say, I should start looking at all of these economic identities that are built into my structural model when they don't matter if we're not past the pandemic. And so I still think those things matter. I still think productivity matters. I still think demographic profile matters, how it pertains to the labor force. I still think understanding the underlying relationship between technology and innovation and productivity matters. But I think till we get through this, that stuff has a much more marginal impact than vaccines and pandemic levels and things like that. And that's just, it's still weird to me. I still feel like this is surreal, like I'm dreaming about this, that it's almost not actually happening. But I'm looking forward to getting back to thinking about structural relationships, like what the natural rate of unemployment is, or the interest rates and things like that. Like I want to know what I want to start to use some of those identities again and have them actually be a big deal, right? Is there a real natural rate of unemployment? Has it structurally come down over time, right? Is there an R star, right? That interest rate that we pay attention to because it's got a lot to say about growth and inflation and things like that. I still think those things exist, but right now they're kind of backburnered because it's almost irrelevant if we can't get past the pandemic, unfortunately.
For sure. Which national economies do you believe will prosper in the future when recession recovers, which, as you mentioned, potentially Q3, Q4 of 21 and onwards?
I think China's off and running. I think China was the massive outperformer last year, not just relative to developed economies, but even other large developing economies. I think China and India are going to outperform by a wide margin this year. I think a lot of economies this year will have a good bounce back. I mean, even in Europe, which suffered more last year than I think North America or the Americas and Asia Pacific did, I think they'll have a good bounce back year. But, if European economies are growing at 4 to 5% this year, I think China and India are growing at 8 to 9% probably. And so if you're banking on economic growth as a driver of investment, I think among the top 15 economies in the world, I think China and India are the clear outperformers this year and probably into next year.
Excellent. Guys, I don't see any more questions. Feel free to unmute yourself. Go ahead, Frank.
Ryan, great presentation. Loved it. So I guess I have a multifaceted question, which is why it's easy for me to just talk about it rather than
Sure.
But you know how it goes in this game, right? With economics. So all that you said, taking it all in, inflation, I think it's fair to say that the Fed has been trying to push inflation for a while so that we can grow, and everything that they're throwing at it is not bringing it, right?
Right.
So with that as a prelude, do you think that, and what you just mentioned with all the other economies growing fairly strongly, and granted, it's difficult to kind of really put a pulse or to put your thumb on the United States, because at the moment there's so much going on in transition, right? People are moving, people are relocating. Like we're having the great relocation out of New York at the moment, California, et cetera. All of that taken into account of, with the debt levels so high and our experimentation in a longer view of fiat currency, do you think that we are, not to sound pessimistic, but do you think that we may be in some, I'll agree that there's perhaps some short-term pent-up demand, but longer term, I see that we may be in for a prolonged, hate to use the word depression. Maybe another way of putting it is like the lost decade, like Japan had, with these levels of debt, notwithstanding what may or may not happen geopolitical, which granted, that's like throwing a dart, right? We can't account for that. But just as things are now, do you see that there's the potential for just a prolonged malaise, if you will, with our debt levels and lack of inflation, of inflating out of it?
Yeah, I think so. The latter half of this decade is where things get objectively interesting. At least, like I said, I normally only look at the model out 5 years, but I run it out 10 to 15 years. What concerns me about that is we are going through massive demographic change right now. And it's very quietly gone unnoticed, because for the last 10 years, we've been, I say we as a society, industry, as zeitgeist, whatever, so fixated on millennials that we're missing the really important story, which is baby boomers aging out of the workforce, retiring, which is changing the ratio between people drawing on the system and people contributing to the system. At the same time, life expectancy is going up, healthcare costs are going up, healthcare consumption is going up. And so what concerns me is that I think short term, we get a boost from pent up demand, reallocation of activity from, say, 20 into 21, 22. I think there's a while where people are still operating above capacity because they remember what it was like at 20. It was miserable. They're running ahead of that. That doesn't last forever. At some point, like I said, gravity starts to come back in and we migrate toward capacity growth rates. My concern in the latter half of the decade is that demographic change is going to start to drag on this. And if we don't have real productivity gains from technology, which again, some people are making that argument, but I'm not hanging my hat on that, then what that argues to me is that with labor force growth slowing down and productivity growth pretty much ossified, because it's not gone anywhere since the end of the tech boom spurt in like the middle of the 2000s, right? So from 94 to 2004, there's a spurt in productivity growth, and then it just comes careening back down, and it's pretty much stayed flat since then. That to me argues structurally lower economic growth rates, and that it's not miserable, but to your point, it could become very Japan-like, where we are growing, I don't know, 1.5% on a real basis. And even on a nominal basis, if there's not a lot of inflation, it's hard to reflate the economy if you can't push, right? The Fed's struggling still to push inflation. Yeah, it could become something like that. And I think the first half of this decade probably changes that narrative a little bit, because we went through this massive implosion in aggregate demand. Then we're going to catch up for a while, run ahead of a little bit. But I'm a big believer in structural trends in the economy. Demographic change is a structural trend. Productivity growth is a structural trend. If we're sitting here in 2026, 27, and we're still stuck with the same kind of labor force growth rates with the demographic change, and we haven't gotten a boost to productivity growth, then we're headed for very pedestrian 1 to 1.5 caliber real GDP growth, which would be a little bit better than Japan, because Japan's gotten good productivity growth, but demographics are moving against them because the population is declining on an absolute basis. They've had a worse demographic profile than we have, which is why I think our trajectory looks a little bit different from theirs. But yeah, it's not hard to envision a scenario where we're mired in this 1 to 1.5% real GDP growth for a while, because demographic change is a really powerful force. And I'm not sure that investing all of our money in things like social media and shopping on Amazon is going to counteract that.
And I realize that there's another question, hypothetical on the board about war, but just as a quick follow-up, with respect to that, what do you think the change in the economy will bring about if with the with the fiat currency, given what it is, and the dollar declining, as we're seeing now?
What's interesting about that is that for the reasonable foreseeable future, I know people have wanted over the last 30 years to find another reserve currency, maybe 40 years, to find another reserve currency to compete with the dollar. And everyone they've tried has failed, right? First, it was the yen when Japan was the #2 economy, and that didn't work. And then they thought it might be the euro once they created that, and then that didn't work. And now people are talking about the yuan, but people don't trust, centralized government and the kind of, just the lack of transparency and sometimes the seemingly ad hoc decisions they make. I'm not saying that the yuan won't more readily start to become more accepted, but I think we get away with a lot of stuff because there's just not a good reserve candidate. I think the biggest risk to that is that we mismanage the economy, that we mismanage our debt, that we mismanage how we go about printing money in the money supply. People lose faith in it, that you start to see a crisis in the treasury market. And then at that point, people start running for the exits a little bit. To me, that's the biggest risk to that. Because I don't see, again, the yen, it didn't work. The euro, it didn't work. I don't think there would have to be a lot of serious change in governance in China for the yuan to really be a competitor with the dollar. And I just don't see the government doing that. If anything, I see more centralized control, more of an authoritarian bent in Chinese government now than maybe at any time over the last 30, 40 years. So I think people have soured on the idea that the government and the economy were going to liberalize in China, and it might more readily become a competitor. I think they've gotten some economic liberalization in terms of businesses and competing. But the way the economy is still run is it's very centralized, state controlled, and I think as long as that persists, it's going to be very difficult for the yuan to be a straight up competitor to the dollar unless we massively mismanage policy here in the U.S. I think that's our biggest risk, really.
Yeah, I agree.
Awesome. Next question, very hypothetical. What impact would war have on the economy?
The textbook definition would say it's generally a good thing because you start marshaling resources into production. I think it depends on the kind of war. If it's the kind of war that happens, somewhere else, at the margin maybe, but we're largely moving away from being a manufacturing-oriented economy to being a services-oriented economy. And that's not to say that the military doesn't use services, but I think it's very different relative to say, World War II, where once you start manufacturing tanks and airplanes and aircraft carriers and things like that, that had a big impact on GDP because manufacturing was such a big part of the economy. If you think about the economy today, it's a lot of healthcare, it's a lot of education, it's a lot of technology. I'm not saying it doesn't have any impact, but I think it, people who want to compare it to the conspiracy theorists who thought Roosevelt let us get attacked in 1941 to cause us to enter the war, that conspiracy theory, I think, holds more water then because manufacturing was the driver of the economy back then. I think these days with education, healthcare, and technology being such big drivers, I think it's harder to make that argument. So at the margin, maybe, but not enough that I think any reasonable politician would think to use it. But I mean, we're starting to have unreasonable politicians now, so who knows? But just objectively, I think it's hard to move the needle on GDP growth since we've become such a post-industrial service economy relative to what it was like when we were still a very industrial manufacturing oriented economy.
Makes sense. Thank you, Ryan. And, I want to be cautious with the time. We have about 6 minutes left. So the question that I see in the chat, and depending how long it takes, we'll try to wrap up by 8:30 as it was promised. So Bitcoin mania, what are your thoughts on that, Ryan?
It's one of those things where it's really hard to know like if you can ever get an intrinsic value out of it, because it's so transparent. It's not backed by any government, it's not backed by gold or any hard tangible asset. But I will tell you, I don't mind trading in and out of it a little bit, so I don't want to sound like a hypocrite. It's not so much that I have faith in Bitcoin. I have faith in people to not understand it and get caught up in the euphoria of it. And so my biggest mistake with Bitcoin is that I have both times I've traded in and out of it, I sold too early. It was a good trade both times. I just wish I'd held on a little bit longer. But my problem is I'm too rational about it. And at some point I'm like this doesn't make any sense. Even as somebody who's just trading for the fun of it, I need to get out of it. I think you can make money in it. I think it's really hard to come up with any metric for fair value and knowing where you should buy in and out. I do something with Bitcoin that I never like to do, which is I'm kind of technical about it. I kind of wait for it to crater for a while and then buy in, and then hang on to it just till it runs up again and then sell out. Like I said, I've been pretty disciplined about buying in the valleys, but I've sold out faster than I should have on the way up, just because, like I said, I haven't seen a good way to value it on any kind of intrinsic basis. And so all I see is, I'm like, I made some money, I should take it off the table, because I don't know, I just don't know where this is going to go. So I've been better buying on the lows than I have been selling on the highs. But I think if you pay attention and you do that kind of analysis, you can trade in and or out. But if you ask me what I think a reasonable fair value is, I don't know. I honestly don't know. I just like trading in and out of it.
Where do stocks, commodities go from present value?
I still think that the stock market's got room to run. Maybe not, the kind of 16%-ish that we got. I think it was 16 or so from the S&P last year. But I think you're going to start to see revenues growing again, earnings growing again. I think some of that's already baked in, which is why I don't think you're going to see repeat performance. But I do think if we get a stimulus plan this year, I think Wall Street will like that. I think they'll see it as supportive to the economy. I think they see more upside to the current administration's spending money than they see downside to potential taxation. So I think at least through this year, I'm just putting my money where my mouth is. I'm still long this year. I'm still buying dollar cost averaging up. I haven't changed my view on that. Ask me again toward the end of the year when I do my portfolio rebalance, I might have a different answer. But I still think the stock market's got room to run this year. I think commodity markets also. I think don't be surprised. I know the energy markets have already rebounded a bit as things have snapped back. I think if the economy starts to run again, I think there's still, again, sort of like last year, not as much bounce back, I think, left in energy as we've already seen. But I still think there's probably some room to run there too, because I don't think everybody is on board with the idea that the economy is going to snap back in the latter half of the year. I still think there are a lot of people that think it's going to struggle. So if you don't think the economy is going to struggle in the latter half of the year, I think there's still room to run in the equity markets and probably the commodity markets too. If you have a more dour view than I do, maybe you're a little bit more cautious about that. But I'm feeling cautiously optimistic about the prospects for the economy in the latter half of the year and beyond. So that informs my my investment view of the world as well.
Great. Rick, go ahead.
Yes, hi. Ryan, I thought that was a great presentation, and
thanks.
I enjoyed it very much. Your first name and last name reminds me of my nephew. An Irish first name and an Italian last name.
It's funny. My mom did that on purpose, actually. My mom didn't want us to have stereotypical Italian first names.
Right.
So I'm Ryan, my sister's Megan, and my brother's Keith. There's no Anthony's or anything like
Yeah.
that. No Maria's. Like my
Right.
mom didn't want any of that. So
And
it's
my
funny that
nephew
you
is
say
named
that.
Ryan too.
Yeah, she wanted no part of the
The mother was
stereotypical
Irish.
Italian thing.
His first wife was Irish. Anyway, let me dovetail off a bit of what Frank said, and which I applaud him on the points of the debt and the malaise that we have to deal with, and kicking the can down the road and have to face up to that at some point. You mentioned 22 trillion, and I see that 27 trillion going over 30 trillion. When we were at 17 trillion, it was way too much for what this country's GDP was. I see the macro environment, macroeconomics overriding and controlling the microeconomics more so this time due to the pandemic. Well, my question to you would be, where would you see like the 10-year treasury, which is at 1.11 right now, 1.11, in 3 months, 6 months, 9 months? And I see that if you'd also comment on gold and commodities and Dr. Copper. I was wondering if you can comment, more to run on the commodities, not the oil so much, but the commodities being gold and copper and silver for that matter.
So I'll preface my statement on interest rates by saying there are really good reasons why the interest rate forecasters Hall of Fame is completely vacant. But that said, I think we're headed upward. If you wanted the discrete answer to that, you could email me and I could yank it out of the forecast. I think the last time I checked, it's generally still trending slowly upward, and then we get to that inflection point in the middle of the year and it starts to tick up a little bit. That said, it's marginal. We struggled, if you remember the last cycle, I mean, we really struggled to get above 3 to 3.5% on the 10. Like that was a serious effort. Like that was a real heavy lift to get back to that. If we get into the, sort of medium term before, any further disruption, if we can get back into the 2s, I think it would be miraculous, because I think this is just, it's a heavy lift because we've done more permanent damage to the economy during this downturn than we did in the last one. So I think it's going to be tougher. I'm not saying we can't get back to 3 on the 10. I think we can migrate back toward that. I think it's a question of how long it takes us to get back there. And I think it's going to be I think at least for a while, it's going to be a slower go to build this back, because like I said, there's more permanent damage in the economy that leads me to think, even with the economic growth rate starting to accelerate in the latter half of the year, we have a bigger hole to climb out of than we did the last time. The one variable that's different is that I think we'll bounce back faster this time than we did the last time. But I think we have a bigger hole just objectively to climb out of, based on the impairment to GDP, based on the impairment to the labor force, things like that. So I think rates are headed upward, but I think it's cautious for a while. And then I think if we can actually start to meaningfully generate more growth and a little more inflation once we get past the pandemic, I think you can start to see them move a bit. But I'm trying to temper everyone's expectations. I think it's going to be hard to get back toward 3-4% anytime soon, because I think the economic environment is going to be tenuous even as the economy starts to grow. On the commodity side, I think it depends, especially when you're talking about gold. Gold to me is often what gets utilized when people are sour on things like inflation and they're sour on a lot of other investments. I think they often see it as kind of a safe haven, kind of a harbor in the tempest in a lot of ways. I think if the economy does well for a while and people are really piling back into stocks and real estate again and things like that, I'm not saying it implodes, but I think it might get overlooked for a little while. And I think maybe some of the commodities that get utilized in for more building and growth purposes, I think it's a little bit different, because I don't think people fully look at those so much as an asset class for investment, so much as a as a bet on an input to production in certain ways. But I think for something like gold, I think we'll really have to see what happens in the stock market. I think if the stock market stays hot and people are still piling in, I think something like gold probably gets overlooked a little bit. But the thing about gold is anytime you run into even a soft patch, I think people tend to jump back in because it's kind of a security blanket. Sounds a little bit disparaging, but I still think it has that role to play. I think it does provide that sense of security and comfort to people when they do start to worry about the stock market and printing too much money and fiat currency and things like that. So I'm not saying it's going to go down necessarily, but I think if the stock market's running hot and the real estate markets are still running hot, I think people might overlook it for a little while.
And just to clarify a point that Frank made, I've been having for years now, is we're running over 130 GDP, our debt over GDP. When does it come home to roost? When do we get the correction? When do we get the bear market?
So the issue with this is that the empirical research is a moving target because every time there's a study published, the answer changes. What I would say is empirically, based on the data that we have, it's somewhere in the high 200%, 270, 280, 290.
That high?
Yeah, that's where you really start to see issues because even Japan is pushing like 260, 270 right now, and there's no real serious negative consequence for that. So we have runway to play with. My concern is that we're probably going to not do anything about this until we cause a crisis with it because there's no political will to fix this. And I throw everybody under the bus for that, right? Because again, I'm a politically agnostic person. This has been going on for 60 years through different administrations and different Congresses. So everyone, Democrats, Republicans, independents, farm animals, everybody's complicit in this over the last 60 years. So my concern with that is nobody in Washington is going to have an honest conversation with people that they need to have, and they're afraid to touch the third rail. And we will get to a point where, to use a technical term, the bond market just vomits all over itself because they've had it with it. And then we're going to be in a world of hurt and we'll probably have to inflate our way out of it. And so my concern is we have runway. I just don't want us to use it because we keep using it when we shouldn't be using it, right? I'm fine if we have to use this during a time of crisis, right? If you have a once in a century pandemic and there's a massive hole in aggregate demand from consumption and investment, I can live with that. What I don't like is when the economy's growing for 10 years and we're still piling on these massive debt increases. It's like did nobody take macroeconomics 101? Like, I wish we had sounder counter-cyclical policy on that. But again, like we don't have any political party that I think believes in that kind of economic management. I think they both like to spend. They both like to borrow money. They just want to do it for different purposes. And again, I'll let you read into the different parties what their favored constituents are, if you will. But neither of them has shown really good fiscal discipline, which is why I have no problem throwing them both under the bus, because this has been going on since 1960 and it's only accelerating. And my concern is once you raise these things up, they become quasi-permanent. Like, we never paid down the debt that we borrowed from the last crisis, and now we're ramping it significantly back up again. That to me is not a responsible thing to do. I would like to see us be more serious counter-cyclical with this. Borrow money and spend money when we need to, pay down debt and not spend money when we don't. But I don't see that will from either major party right now.
You hit the nail on the head on that one, Ryan.
Oh, I hate them both. I mean, not equivalently, but I do not like either of them, because at least from a macroeconomics point of view, I think they're both leading us down a dark and dangerous road. We're kicking a can down a road and we don't know how long the road is.
A dark and dangerous road, or the waterfalls, just to go over. As
in a barrel, like Niagara.
Yeah, exactly. As you said, and true. Just as you said, we are all at fault for this, because and we collectively, generally speaking, everybody has their hand out. Every time there's an issue, oh, I need help, I need help, I need help.
Yeah,
And they're too happy to do it.
It's everyone, right? Like, and again, this is why, like, I think there's this popular perception out there that like one party is like responsible with the economy and the other one isn't, but that's not true. Like, go back and look at the last 60 years. Neither of them have been responsible with debts and deficits, right? Again, they have their favored pet projects, and I'll let you read into that whatever you want to, but just go look it up. There have only been 4 years. There's been 4 years in the last like 60 years where we've run a budget surplus, at the end of the Clinton administration and the very beginning of the W administration. That's it. 4 years and 60 years. You've had turnovers in the White House. You've had turnovers in the House. You've had turnovers in the Senate, and we're still doing the same stuff. So the idea, and I always know when somebody's like politically inclined or has a political bent, because they want to throw the other party under the bus. And I'm like, oh, time out. I'm like, your party does irresponsible things too. People just don't always want to see that. But if people are being honest about it and they take a hard look at the last 40, 50, 60 years, they will see Democrat and Republican administrations and Democrat and Republican Congresses doing irresponsible things and getting away with it. It's just when they're doing the things that you like, you don't make a big deal about it. When the other party's doing things that you don't like, then you rattle your saber about it. That's how this works, unfortunately.
Ryan, it's been said that the previous administration of Clinton, which was Republican and House and Senate, I believe, and put the policies in place for Clinton to benefit with it. But he did run a surplus, and we did have a balanced budget.
Yeah, I mean, I didn't mind that model, right? I didn't mind, compromise, unfortunately, has become like a 4-letter word. Like, I didn't mind the idea that we had a Democrat in the White House and Republicans in Congress, and we ran a responsible budget. Like, that doesn't, again, I'm not a political person, so the composition doesn't bother me. What bothers me is irresponsible policy making. So
I agree
if
with you 110%.
divided government produces compromise and good policy making, I have no problem with that whatsoever. Like I said, I don't identify with any party. I don't donate to campaigns. I don't go to any rallies. There are no signs on my lawn. Politics is not my thing. I pay attention to it because it's important to understand the economy. And I find political science interesting as an academic discipline. But politics to me, I hate, because as I was saying before, decisions are often made with political expediency and the economy be damned. And that drives me nuts.
Hi, Ryan. Quick question.
The life of an economist, Ryan. It's tough.
Yeah.
Ryan, we do want to wrap up in a few minutes, but people are asking for your contact information.
Yeah, you can share it, and I'm happy to answer questions. Like, if people want to ask a few more questions, unless everyone needs to go, like, I'm happy to answer questions. So
yeah, no, I do want to wrap up in a few minutes, but guys, Ryan is on LinkedIn, so whoever wants to find him easily, you can find him on LinkedIn. I don't know if you use any other platforms.
Twitter, but the best place to find me is LinkedIn. It's the easiest place to find me.
Yeah. Okay. Go ahead. Who was that, Eric?
Oh, yeah. Hi. Quick question on the whole debt deficit thing. What do you think is I guess in terms of the economy and long-term outlook, the best way to get out? Would it be taxes, cut spending, combo of both, other means?
Yeah. If we're being honest about it, I'd say it's probably both, because I don't think there's any panacea to fix this. I think if we were having an honest conversation with the American public, we would probably have to tell them some combination of, and I'll let the policymakers hash out exactly how that comes about, but probably some combination of spending cuts and tax increases. We probably need to do both, right? Imagine like your own household. You're like, oh, we're underwater. We need to raise revenues however we can, and we need to cut spending where we can. And I think, to me, that's a reasonable solution, because then you don't have to take drastic solutions on either side, on the revenue side or the expense side. That would be, I like that, because for that very reason, because if you had to make more drastic measures on one side or the other, you're more inclined to get political blowback against that. So if you just came out and said, we're raising taxes significantly because we have to raise revenues to get things in order, people would be like, oh, taxes are anathema, like we can't go for that. Or if you came out and said, we're cutting spending dramatically because we have to get our house in order, then somebody's going to come out and say, well, that's too draconian. We can't. No, we're not countenancing that. I think if we're being honest about it, we should start to make these changes now so that we can I know this is like, I might as well be asking Santa Claus for, you know, a flux capacitor or something. But if we make these changes sooner, we can be more marginal about it, and we can do it gradually over time. My concern is that nobody wants to have this honest conversation. Nobody wants to do this. And so they'll wait until it's a crisis. It'll blow up in our faces, and then we will have to take more significant measures. So I'd rather see, like, you know, marginal changes in taxes that are not overly disruptive, marginal changes in spending that are not overly disruptive. And let's like slowly start to repair this, because if we don't, kicking the can down the road, like I said, you can kick the can down the road for a while, but eventually you're going to run out of road, and then it is going to be a serious problem. So if it were up to me, I tend to not, you know, I try not to tell people what they should and shouldn't do, but I'd rather make small changes on both sides of this, do it incrementally over time, and then like you won't have this massive bloodletting. If you wait, then you're in for more pain all at once, and that's the kind of thing that will not only cause you know, economic disruptions, but you're probably going to get political and social. Not that we need any more of that recently, but you're probably also more inclined to get social political unrest out of it, and that, you know, that's a variable that can really start to spiral out of control.
Thank you.
Awesome.
Anytime.
Thank you so much, Brian. Sorry, guys, I'm getting a call on the line. Great presentation. Again, guys, if you need to find Ryan, he's on LinkedIn. Feel free to reach out.
Seriously, reach out, connect with me, ask questions. I'm always happy to help whenever I can. So,
awesome.
Ryan, it was good to see you again.
You too. Take care, everybody. Stay safe.
Thanks, Ryan.
Honestly, if I can help at all, say hello. I'm more than happy.
Thank you very much, Ryan. Appreciate everything.
Bye, guys.
Appreciate it all.